Good morning, ladies and gentlemen, and welcome to our H1 2022 presentation. We have defined this period as a challenging period, and I think as we go through the presentation, you will see why. Obviously, there are forward-looking statements, so please take note of our safe harbor statement. If I can then move on to the agenda. As always, we will start with safety and ESG. I'll cover that. I would like to do a recap on our strategic positioning, combined with a complex global backdrop. We did introduce you to our grey elephants at our year-end results in February of this year, and I think it's a good time just to recap. I will then hand over to the two chief regional officers, being Richard and Charles Carter, Richard Stewart and Charles Carter. Richard will cover the South African region, Charles will cover the US region, and our new head of recycling, Grant Stewart, will cover the recycling segment. Grant will hand over to Charles Carter, our Chief Financial Officer, and Charles will cover the financial results, and then I'll conclude with a brief conclusion. So please sit back, enjoy, and relax if you can. As I said, health and safety and ESG are our primary focus areas. They are our first, second, and third priorities. Our focus on the fatal elimination strategy is an imperative for 2022. We had a shocking 2021. I'm pleased to say we've made really good progress. Post all the shaft stoppages that we introduced ourselves towards the end of last year, and some of them even went in to the beginning of this year, we brought in an independent safety expert to review our safety strategy. I'm very pleased to say that he ratified our safety strategy as consistent with global industry standards, and of course we were quite relieved with that. What we did find, though, is that perhaps the ownership of that strategy was not owned throughout the organization, and certainly at some of the lower levels. We need to institutionalize and get ownership of our strategy and our safety commitments, and we worked very hard on that, and we have achieved some good results and have made good progress. Of course, you will not progress safety unless you make real risk reduction initiatives an imperative, and we have had real risk reduction in our company, and that we've achieved through critical controls. We call it our critical life-saving behaviors and critical management routines, and those are non-negotiable issues in our company. So let's have a look at what we've achieved. So we've certainly maintained the improving safety trends that we were achieving towards the end of 2021. Unfortunately, we have lost two of our colleagues in accidents that certainly are accidents you would find very unusual. The one is we had a driver jump from a moving train due to a flash, an electrical flash, and then we had a very unfortunate surface rail accident regarding a hopper door in February. So that's very disappointing, but very pleasing. We had 0 fatal accidents in 2022. And if you look at the direction or the trends of our injuries, of our fatal injury frequency rate, and of the TRIFR, it's all heading in the right direction, and we can see it on the ground as well. So I have a lot of confidence that this will be a much better year from a safety perspective. If we just talk a little bit about ESG, and there are many things to talk about when you talk ESG, but I thought it was appropriate and timely just to talk about what we call our Marikana renewal. It's a tragic legacy that we have taken on. I don't even want to use the words inherited. We have taken it on based on the acquisition of Lonmin, and last week we had the 10th anniversary of that tragedy. In 2020 we introduced what we call the renewal process, and it has 3 pillars: honor, engage, and create. And we've made good progress with this. First of all, we made commitments to all the widows and families, and you may remember that initially there were only 34 widows recognised before we became involved, where in fact there were 44. There were people that lost their lives very tragically even before the actual Marikana tragedy. Through the 1608 Memorial Trust, we've educated the children of those widows. I'm not going to go through it in detail. It is set out very clearly in the table on the right-hand slide. Very pleasing. We've had our first PhD come through that system, and I'm very pleased to say we've employed that person. So Mandla now works with us. This is a long journey, and it requires stakeholder collaboration. All stakeholders are invited to participate, but I can assure you those that don't are not going to slow us down. We've got good momentum. The key stakeholders are working with us. The widows are working with us. It's a journey of renewal and hope. It does require trust building between stakeholders. Our commitment to co-create the future for Marikana is sincere, but change will not happen overnight. So I would urge you not to look for big changes every year. This is a long journey. The Letsema process is fostering regular and open engagement. If you want to understand more about that process, we have put a link at the bottom of the slide where you can go and actually have a look at what it includes. We have finally got all the families together, established a task team to deal with the legacy issues, including the memorial. There was no point in us erecting a memorial that suited one stakeholder. The people that require closure, those widows, they are the important beneficiaries of a memorial, and we now have alignment, and we have a process further forward, and I hope that in a year's time we will be able to show you absolute progress. On site may not be complete because it's going to be a substantial memorial. There's one area of confusion that I do want to just clear up. We have taken on the obligations of what we call SLP2. This was approved by the Competition Commission, and of course we've got our own new SLP3, but we did not take on any obligations prior to SLP2. So we have no obligations on SLP1, and there's lots of confusion around that, and I really just wanted to clear that up. So looking at strategy now, I want to just refresh your memory. And based on the grey elephants, which I'm going to come to after this slide, we developed what we call our three-dimensional strategy, which is designed to harness opportunities and manage in this very complex environment, this very complex backdrop. And I'm going to cover the backdrop and how it's changed from 2021 to 2022. Our strategic foundation is essentially the same foundation we've had. There's been some minor revisions to wording. We've included one additional value to our cares values. We now talk about I-cares. We've introduced innovation. We think it's an important cross-cutting value that is required to achieve the strategic differentiators. What has made us successful up until now is really encompassed in the foundation and in the strategic essentials. And they are not things that we are going to forget. They are absolutely essentials. And I would even suggest that the second half of this year, there will be much more focus on those essentials to ensure we deliver on our plans and achieve operating excellence. The strategic differentiators continue to be worked on. We continue to set out processes to do the due diligence on various issues so that we can deliver on our strategic differentiators. But just to remind you what they are, being recognized as a force for good, that is part of our vision. Building a unique portfolio of green metals, that's PGMs, battery metals and others, and being involved in energy solutions that reverse climate change. That in itself feeds into being recognized as a force for good. Out of some of the grey elephants, which again I will cover shortly, we developed the differentiator of being inclusive, diverse and bionic. And I honestly believe that diversity and inclusion and using technology in the right way will leapfrog us ahead of our competition. And then, of course, pandemics and being resilient to them. COVID was the first of many to come. And pandemics are not just viral pandemics. The Russian invasion of the Ukraine is, in our language, a pandemic. So that's the three-dimensional strategy that we introduced to you at the beginning of the year, and it's the strategy that we continue to build our company on. So let's now move on to the grey elephants, and a grey elephant is a highly probable and high impact factor that will transform the 2020s. And we went through these in some detail, and there's 8 of them. Pandemics, I've already referred to the pandemics, and from a viral point of view, we can expect more COVIDs. In fact, the World Health Organization has predicted another 3 pandemics this decade. But in our language, pandemics is also highly disruptive events such as the invasion of the Ukraine. The grey elephant of aging. The world is getting older. People are older. By 2030, there will be more older people than young people below the age of 9. Those are very important issues to be cognizant of in terms of ensuring that you have future-ready leaders and a workforce that is going to be older. The angry planet is well understood, probably of all the grey elephants. Climate change, the need to deal with achieve carbon neutrality, decarbonization. It's a real challenge, but it's a real opportunity as well. Inequality is well understood. In fact, 9 out of 10 people of the most unequal people in the world are in Africa, and we operate extensively in Africa, and therefore we have to be very cognizant of that. The events of July last year is a very good example of inequality coming to the fore. But it's not just an African issue; it's an issue. It's an international issue. Big squeezes, they started to appear in COVID with supply chain disruptions. They continue to manifest themselves through the invasion of the Ukraine in terms of energy shortages and other disruptions to the supply chains that we are dependent on. It's an ongoing issue, and in fact, our strategy to become part of ecosystems in Europe and North America is designed to get around some of those issues. Every grey elephant here has an outcome that results in angry people. And again, if I refer to the outcomes or the riots in July that we experienced in South Africa, that's angry people. And if you don't take cognizance of it, I dare say that you're going to have a very volatile operating environment. Multipolarity is another area that we have seen. We could not predict the invasion of the Ukraine by Russia, but we could predict, due to what we saw in COVID, that that globalization was going to unravel. It's actually accelerated because of that particular pandemic, that invasion of the Ukraine. We've seen the East and the West aligning with Western allies and Eastern allies. The world has recognized that 90% of what's required for antibiotics comes out of China. The US has very recently introduced legislation to make them less dependent on the battery aspects of China and so on. Again, our positioning in Europe and North America has really become quite successful because of our identification of this deglobalization issue. And then, of course, artificial intelligence. You would remember me describing how the industrial revolutions have been hard on people, and how the fifth industrial revolution needs to be very different. It needs to consider people, it needs to make it easier for people, and not be hard on people, and how we have therefore from that developed the strategic essential to be inclusive, diverse, and bionic. And in fact, one of the first steps in that is becoming more digital in the way we work. So that's the backdrop, and a lot of that backdrop is playing out and providing us with opportunities because we are pre-prepared for that. So let's have a look at the next slide, which shows us how this environment, which we think is similar, has changed between 2021 and 2022. And I'm not going to go through all the detail on the slide, but in 2021, we were just coming out of COVID. There was widespread economic stimulus to address the COVID distress. There was stuttering recovery in automotive production because of the supply chain issues and different lockdowns across the globe, which, of course, I just want to again say has changed the view of many companies to regionalize their supply chains, and we've positioned ourselves in those regions. There was the increased commitment to global decarbonization, and the environment we found ourselves in was one that was partially inflationary, but low interest rates. To some extent, Europe was in a worse position than the US, but we could just start seeing a bit of inflation. And then in 2022, early in 2022, we had Russia invading the Ukraine, and that really accelerated the inflationary issues. And of course, with central banks now moving to deal with inflation and raising interest rates, where you had Europe already in a weak economic position. That has basically pushed Europe into a recession, and in fact we are starting to see the same things happening in the US. So where we had pent-up demand in 2021, the spending power of consumers has changed dramatically in 2022, and again, instead of having chip shortages, we now have other supply chain issues such as wiring harnesses that were manufactured in the Ukraine, affecting the demand side of our business. The acceleration to carbon neutrality has increased, and again, we are well positioned, having restructured and repositioned our business to focus on green metals, being battery metals, PGMs, and so on. So a very different environment in 2022 compared to 2021. So let's move on with that as background. So as you've heard me say a few times now, the fact that we moved very early to position ourselves in regional supply chains rather than global supply chains has put the company in a very good position. We have realized pandemics are more than just COVID-19, and there's going to be many more of them. The regional supply chains is really the multipolarity, and of course the big squeezes. We want to be part of the solution in terms of what we produce. So we are well positioned. I just want to really highlight one other thing. The multipolarity you now see playing out in the recently released US Inflation Reduction Act, and that's good for those companies that are positioned in the US. Our view is that it will slow battery electric vehicle penetration in the US, but it's positive for us, but good for battery electric vehicles in the long run. So that is just one aspect I wanted to cover, and the next one is our positioning in Europe. So we have moved to secure our position in Keliber. Keliber is a wonderful project. It's an advanced lithium hydroxide project in Finland. It will produce some of the greenest lithium, and not only that, it's close to the end user market. So when you look at total carbon footprint, this is going to be the greenest lithium in Europe, and we will get a premium for it, and it underpins our need to reduce carbon footprints. But the investment to date and the funding is set out in the bullet points below that heading. We do anticipate owning a little bit more than 80%, and Keliber will effectively be fully funded through our equity investment and growth, and an equally sized debt facility. And in our view, that gives us the most opportunity to take advantage of future lithium prices without having to contract into current structures. The detailed feasibility study, the increase in ore reserves confirms the quality of this project. Our entry point has been achieved at about 30% of net asset value at conservative lithium prices. So this is very value accretive, and will be a real underpin to our battery metals initiatives. We do like what we see in terms of battery metal outlooks, and I'll cover that in the next slide. But of course, the permits are also progressing nicely. So let's just pick up on battery metals and the continued strong EV demand pull. Now, I've been the first one to say that penetration rates, in my view, are hugely overstated in many cases. Having said that, I do believe that this is still going to be a very significant segment of the market, and some interesting developments are coming to the fore. So despite the impact of supply chain issues on internal combustion engines and high battery metal prices, battery electric vehicle sales in H1 of 2022 were up 75% year on year. In contrast, other sales are down just under 9% over the same period. So this is real outperformance, and I think if I sense there is a group that poo-poos the inroads that battery electric vehicles are going to make. I'm not in the camp where there's going to be huge penetration, but there is going to be very significant penetration and I think quite significant outperformance. The other thing that is becoming apparent is that growth or that year-on-year growth shows that to some extent it's inelastic to battery commodity prices, which I found strange. I don't intend to go through the rest of the slide in detail, just to say I'm happy that we're in this space. It doesn't mean we've lost faith in PGMs at all. We've always been strong proponents of the internal combustion engine, but you can see some very significant companies are actually now starting to invest in the upstream areas of the business. So good for our business, and I think there's good long-term prospects from this part of the market. So let me, just as a lead into the operational updates, let me just talk you through the salient features. So despite the challenges of underperformance on volume in South African PGMs, the floods in Montana, the industrial action in our gold business, we still delivered a solid financial performance. It's our third highest attributable profit of 12.3 billion. So that's not a bad result. Of course, it could have been better. Our net cash position was maintained, and if you look at our ratios, our debt ratios, we're on a 0.16 times net cash to adjusted EBITDA. So that we have maintained, and again, pleasing considering the challenges. Our commitment to dividends is unchanged. We calculated the interim dividend at 35% of normalized earnings, and that's at the top end of our dividend policy. It amounts to R1.38 per share, or 32.46 US cents per ADR. It's a significant amount of money at 3.9 billion, and it's equivalent to a 7% annualized yield, very decent. Looking at some other salient features, we held the line, we held our ground, we did not give in to unreasonable demands, and we achieved an inflation-linked 3-year settlement. Unfortunately, that was with a lot of industrial action, but Richard will give you some of the other wins that have come out of that, and hopefully we don't have to go through this industrial action every time there's wage negotiations. Our lockout, which was unpopular with the unions, served its purpose in that there was no inter-union violence. There was no platform for that to take place. It came at a cost, but you cannot put cost to a person's life. And if we have to do the same thing again, we will. In terms of the South African PGMs, I've already alluded to the fact that there was some volume underperformance, which makes achievement of good costs even that much more difficult. And it's one of the standouts of this business, especially compared to peers who continue to show well in excess of 7-8% increasing cost. This segment has shown very small increases in all-in sustaining costs, and I have no doubt with higher volumes that'll even come down. And we will position all of our businesses towards the lower quartile in the PGM segment. The US was severely impacted by the flood. We presented that a few weeks back. We are looking through the palladium commodity cycle, and we've re-engineered a very different plan, much lower cost structure, which will ensure the margins of this business when you look through the commodity cycle. So Charles will not spend a lot of time on the change in that plan, but we'll provide an update. I've already covered, as I say, as a very important positioning in Europe. The company extended its ownership of Keliber, and I think in a very, very value accretive way. And then, of course, Sandouville is being integrated, and we like what we see at Sandouville. There's still some challenges. We've got to up the volume, but that was all factored into our due diligence, the feasibility studies, in terms of the production of nickel sulfate, as opposed to other nickel products as a battery metal precursor is currently taking place. And we are also progressing our PGM recycling facility at that site with a view to capturing a significant part of the European recycling market. So with that, those are the salient features. I will now hand over to Richard Stewart to cover the South African region. Thank you. Go ahead, Richard.
Thank you very much, Neil, and good morning, ladies and gentlemen. I think in terms of the Southern African region's operating update, the first half of the year was really characterized by the industrial action we experienced on our gold operations. That commenced in March of the first quarter, and really we only got back to production in July, started production again in July. In addition to that, we undertook remediation at our Beatrix tailings storage facility that commenced in December. And as a result, Beatrix did not have any production outputs for the first half of this year. As a result of those two things combined, production was significantly lower year on year than compared to the comparative period, at just over 190,000 ounces for the first half. Of this, DRD Gold, who was not impacted by the industrial action, contributed just over 91,000 ounces of that total output. I think with production having commenced again in July, we certainly are looking forward to a significant improvement in the second half of the year, where we are forecasting in the region of 350,000 ounces from our operations, excluding DRD Gold, with the ramp-up post the strike period. I think it would be good just to touch a little bit on the wage negotiations. As you know, industrial action commenced on the 9th of March, and that was after 10 months of extensive negotiations, many of which were facilitated by the CCMA. I think at the same time as the strike issue was notified, we exercised our right to implement a lockout of employees, and there were largely two reasons for doing this. The first one was, of course, to exercise our right to manage our cost and our business during the industrial action, but also to limit or to provide safety to employees in an attempt to limit the violence and intimidation which was a significant aspect of the previous industrial action we experienced in 2018. I dare say this was successful, with very little levels of violence or intimidation experienced. I also think credit needs to go to our management teams who implemented their strike plans and very proactively managed the overhead costs of the gold business, which significantly reduced the financial impact during this period. After 2 months into the strike, we specifically requested the assistance of the CCMA through a formal Section 150 mediation process. I think we have to give full credit to the CCMA, who under a lot of political and public pressure ran a very independent process with a lot of integrity, and that resulted in an outcome of a 3-year wage agreement that was largely in line with inflation at 6.3% average increase per annum over the 3 years. I think in addition to settling wages at a in line with inflation increase, some other notable outcomes that we managed to achieve was a wage averaging agreement. This is really a legacy item, particularly in the gold industry, that has been in dispute for several years, and we were finally able to conclude that with organised labour. In addition, it is a full and final settlement, so it does provide 3 years of stability to these operations, and we were able to reclaim some debt by employees that was incurred during the strike, which we agreed to partially offset through an ex gratia payment that was part of the ultimate settlement. I think it's important to recognise, though, that why we undertook this was really to be consistent not only with our values, but this was very necessary to protect the long-term sustainability of our operations. And I dare say this is an approach that is required by the entire industry to protect our sustainability and competitiveness going forward. Moving forward, wage negotiations and wage increases have to be linked to inflation. Without doing this, we will negatively impact all stakeholders in the long term, and that includes our employees. I think the other important aspect is we were able to firmly get onto the table the discussion around a more variable linked wage package, aligning all stakeholders, and I'll touch on that. But I truly hope that out of this action, there's been some learnings by all stakeholders that we can use going forward to more constructive and sustainable wage negotiations in the future. When we look at our wages, I think we ask ourselves 3 questions. The first question that is critical is, are our wages fair? Looking at this graph that goes back to 2013, which is when Sibanye-Stillwater started, and when we look at that over the last 8 to 9 years up to 2021, what we can see is that our entry-level employees have seen wages increase by about 84% over the period. Over the same time, inflation has gone up about 46%. So what this really means is entry-level employees have seen a real wage increase in the region of 40%. And we recognise that this was very necessary in order to make those wages fair and to create parity with entry-level employees. But the second question we have to ask ourselves is, going forward, are our increases linked to inflation? And this is a critical question, because if our wages are fair, and we did a lot of benchmarking against not only other industries but our own industry, but if our wages are fair and we continue with the trend that we are currently seeing, all we are doing when we have a cost base that's a 50 to 60% comprising of salaries and wages, all we are doing is significantly eating into our margins, and through cycles, this will impact the sustainability of our operations. It will also make us less globally competitive and ultimately be to the detriment of all stakeholders. I think when we're sitting in an environment like we're sitting in now, where there are inflationary pressures across the board, again, continuing to pay above inflation increases simply perpetuates those inflationary pressures and results in them lasting longer than they should. And that is not in the national interest or anybody's interest. So ultimately, moving forward, we have to align these to inflation if we want to remain sustainable and competitive as a company and as an industry. The third question that we ask ourselves then is, how does our wage increases impact on the overall sustainability of the operations? And of course, that is a question around the margins and the profitability of those operations, not just today, but through mining cycles. And this is where the introduction of a variable wage component becomes so critical, because it truly does align all stakeholders, where all of us, including employees, benefit during the up cycles, and all tighten our belts during the down cycles to ensure that we can be sustainable for the inevitable upcycle again. This is a conversation that needs to be progressed within our operations, and again, I dare say, across the industry as a whole. Moving on to our PGM operations, the first half of this year saw an 8% reduction relative to the comparison period of last year. A portion of that reduction was planned and expected, particularly at our Kroondal operations, where we do have some shafts that are winding down and in fact due for closure later this year and early next year. Other challenges that we faced on production was we did have some technical issues where we were mining through a significant fault structure at Bathopele and some seismicity at our deeper conventional operations. Other than that, I think many of the challenges common to our industry peers, including power disruptions, community disruptions, and of course extensive cable theft, which has become a real challenge over the last few months and one we are certainly getting to grips with. Despite this reduction in output, however, I think it's extremely pleasing that we managed to maintain our costs. Our total unit costs with the lower production output increased by 7%, which is largely in line with inflation, but significantly below mining inflation, which is closer to 12% for the year to date. Those two combined gave us an EBITDA of just over 21 billion, which is still, despite reduced PGM prices, the second highest EBITDA that we have achieved from these operations. Very pleasingly, our K4 project has also progressed according to plan, and we hoisted our first tons in May from that project, with significant underground and on-reef development currently taking place. Our wage negotiations at Rustenburg and Marikana commenced at the beginning of this month, and we continue to engage with organised labour. Finally, we also paid a significant payment of the 35% cash flows from Rustenburg to Anglo Platinum, which is in line with the original acquisition agreement, and that last payment is due to conclude this year, and we certainly look forward to those additional cash flows reporting to Rustenburg from next year onwards. I think the continued focus on costs has been very pleasing. When we acquired Rustenburg and Marikana, these were operations that sat at the top end of the cost curve, squarely within the fourth quartile, and the sustained focus on these costs and the benefits that we've seen from integrating these assets into the broader Sibanye-Stillwater group has meant that they have now comfortably moved down into the third quartile, and certainly we are on track to ultimately get them into the second quartile, which was always our original objective. I think Kroondal remains comfortably at the bottom end of the cost curve, as does Mimosa, but a very pleasing output during some very challenging operational times. In terms of the PGM market outlook, it's been a volatile first half to the year, I think both from a supply and from a demand perspective. On the supply side, we've obviously had the Ukraine-Russian conflict, which I think put several shocks into the system, but as we've seen of late, has probably had a very limited impact on total Russian supply finding its way into global supply chains. I think probably more important is that due to the sanctions in Russia, we are seeing a limitation and unavailability of capital equipment within the country, and we certainly think that could result in a constraint, certainly in growth and possible production out of Russia in the medium term. I think we've also had extensive engagements and with the market in the last couple of weeks at our US PGM operations. There we've seen a supply disruption due to the flooding events that we experienced a few months ago. And also we are repositioning that asset in line with our outlook for the market, which will have another impact on PGM ounces on an annual basis on supply going forward. In South Africa, several disruptions to supply, including wage negotiations and power constraints. And then on the secondary supply side, we also expect that to be lower by about 10% over the course of this year. Largely driven by two reasons. We are seeing fewer cars being scrapped. A lot of that, again, got to do with inflationary pressures, as well as significant logistics constraints in that secondary supply chain, which remain. On the demand side, we have seen a revision down of the forecasts for light-duty vehicles, seeing demands down to, or forecasts down to about 80 million units for this year. That's just under a 10% reduction from original forecasts, and that's been driven by a myriad of factors. Certainly earlier in the year, the semiconductor chip shortages was still a big issue, although that does seem to be easing now. We had wiring harness constraints that came out of Ukraine, lockdowns in China associated with COVID, and of course the economic pressures in terms of inflation and car prices and availability at all-time highs. Jewelry demand remains under pressure as well, particularly in China due to the continued current difficult macro conditions. So net looking at it for the year, both a negative supply on both, or negative impact on both the supply and on the demand side. How that impacts on our outlook, we still see 2022 a slight deficit in terms of palladium demand and a slight surplus on the platinum side. Important to highlight, this is before any potential investment demand on either of the metals. Rhodium we see in being in balance, and as we move forward into next year, platinum being in a slight surplus and rhodium and palladium being more in balance. In terms of our operational guidance for the year, I think there was extensive engagement, as I mentioned, on the new US PGM operations and the plans that they have put forward. So their guidance for this year is about 450,000 ounces, and US recycling about 700,000 for the reasons I've mentioned. Our PGM operation guidance remains the same. We are largely in line with that and comfortable that remains the same for the balance of the year. And our gold operations, we are forecasting around 450,000 ounces for the year, excluding DRD, given the ramp up in production we've started seeing since July. That does come as well with a reduction in our capital guidance down to 3.9 billion rand, of which about 1.1 will be on the Burnstone project and about 270 on the Kloof project. Given the significant ramp up, it does negatively impact costs, wherefore most of the third quarter we will be incurring full costs but still ramping up production, and overall cost guidance in the region of about 1.4 million rand per kilogram. Thank you very much, and I'll now hand over to Charles for the US region.
Thank you, Richard, and good morning, everyone. You'll be familiar by now with the impact of the flood event in Montana on the second quarter results. For those of you who did not see the specific presentation on that on August 11th, you'll find it on the company website. It's very detailed, and I would encourage you to go there to get more context on the highlights that I'm going to cover now. So the Montana flood event hit just at the end of the second week of June, so it really impacted the last 2 weeks of the quarter. While East Boulder and the Met plant were largely unaffected, it was really the Stillwater mine that was taken out for 7 weeks due to no access and river infrastructure that needed addressing on the mine site. So the impact on the quarter is really 15,000 2E ounces, and for the half year has been estimated to be 60,000 2E ounces for 2022. At the detailed presentation on August 11th, we went into the revised mine plan at length, and we also highlighted the fact that we're dealing with significant current events, both macro in the US and specific to Montana and the operations. And we looked at the mine plan also in the context of potential future price retracement, in the context of a potential recession. And the market is well aware of the elevated inflation impacts we're currently dealing with. And then nationally in the States right now, all businesses are impacted by various skills shortages, mining specifically, and in Montana these are somewhat compounded by the nature of our operations, distance for travel, lack of housing, proximate to mine, and so on. So we are dealing with a significant skill shortage at all operations right now and significant turnover. And the plan is seeking to address that over the medium term with a big focus on recruitment, retention, and training, given that we are now already seeing a younger workforce enter these operations. But the impact of the skills shortage and then the over-reliance short-term on contractors, which is also impacting cost structures, is something we're looking to address in the medium-term plan. And so the plan that we put forward on August 11th, that over 5 years really gets these operations to start to deliver to their potential, opens up greater operating flexibility, specifically at Stillwater Mine, where we've got to push hard on the developed state, which is both primary and secondary development, everything impacting production readiness. At each of the production stopes is going to take a bit of time because we're building off a developed state that's really 4 to 6 months currently. We want to get it to 12 to 18 months, more in line with the East Boulder operation. And so that plan really starts to get us there over the next few years. Obviously, we have high cost structures in the interim, and we have productivities that we're working hard to improve. And both linked to the macro and economic environment is the specific ore body context that Wayne Robinson dealt with in detail at that August 11th presentation, which you can review on the website. And he spoke to the fact that at Stillwater Mine, we're working through a depression zone and a number of fault structures, which means minimal recoveries through the mining cycle. That's impacting, obviously, grades, and it's impacting associated mining costs. But as we get through that, we start to open up ore body flexibility, and we start to open up good grades and good recoveries, and that'll have a knock-on effect to improve cost structures. And you'll see in that presentation that we step up there over the next several years, and we're looking forward to that. Wherever possible, we'll bring that forward. But it's not a quick fix at Stillwater. But what the presentation on August the 11th also did in great detail, which Neil spoke through on the day, was the fact that this has been a very good acquisition over the last 5 years since acquisition. It's more than paid back the original investment cost, and you'll see on the graph that the current NPV, which is done at reserve pricing $1,250 an ounce on palladium and on platinum, gives us a significant return going forward. And I would argue that as we get this mine plan right and the deliveries right, that NPV, obviously, depending on price and other assumptions, improves. So strategically, a very good move at a difficult time in the market on the day when they did it. But it's a world-class ore body with good optionality going forward. And our aim as management is to start to daylight that. So the payback is already in hand. And I think in the plan that we've put forward, although investors and analysts will be disappointed on short-term, no quick fixes, over the 3 to 5 years, we really start to open that up, and we start to get to a steady state of 700,000 or above 2E ounces, a very competitive cost structure below $1,000 an ounce. And I think you have flexibility on that once you start to get there. So for these results, significant flood impact now dealt with, and Stillwater is back in production and performing as we speak. We still have some access limitations to the mine site that we've got temporary workarounds on, specifically the main access road, which is a county road. The county is working with FEMA to try and address that, and we are in daily discussions on how to expedite that. But we have all 3 operations back performing like they should, and I think you'll start to see that in the results going forward. Thank you. With that, let me hand you over to Grant to talk to the recycling business. Thank you.
Thanks, Charles. And let's not forget those 700,000 ounces also not only coming in a good all-in sustaining cost, but also a good carbon footprint as well. But thank you, and good day to all of those listening in. The decline of the Fed recycled ounces by 10% when compared to the first half of 2021 was not only impacted by the flooding incident and reduced underground concentrate, but also due to the planned shutdowns and the collapsing scrap steel prices. Scrap steel prices have declined by some 25% in US dollar terms in Europe, China, and the US in the last 3 months, reducing the incentives to scrap vehicles. Despite the poor outlook, however, we have plans to secure operational sustainability by 1, securing and growing our customer base receipt rates through proactive engagement, strategic partnerships, and smart contract management, and 2, real margin accretion and increasing inventory turnover. The drop in adjusted EBITDA for the second half of 2021 from $50 million to $39 million in the first half of this year, despite similar feed rates, is largely due to price. In the second half of 2022, we sold a similar number of ounces at a quarter of the price per ounce realized in the second half of 2021. We also sit with a higher working capital balance of some $511 million at the end of June, largely due to a higher basket price with rhodium the front runner. We are expecting a reduction in inventory and working capital when these ounces turn out in the coming months, especially with rhodium, which takes slightly longer. We should also see a lower balance following the lower quantities we are currently receiving. Our recycled business is largely self-funded from internally generated cash flows, and so advances are funded from current cash holdings. The advances are secured and assayed inventory on site with predetermined settlement rates for the advances. Consequently, these funds are largely risk-free and attract a very favorable interest yield. Interest income from prepayments through the half was $10 million. One of the key market advantages in our existing expertise in the recycling of PGMs and our longevity in the space. Our feeder network extends across the globe despite our North American collector bias. Our skill in the smelting space, particularly when it comes to the smelting of carbon-rich catalysts, is also a competitive advantage, and so we are progressing studies and test work to expand our recycling operations in Europe. In addition, we plan to leverage our established relationships to enter new markets and close the loop on battery metal recycling and the hydrogen economy. The growth strategy supports our green metal focus, and with our recycled ounces coming in at less than 0.2 tons of carbon dioxide equivalent per ounce, some 6.5 times less than the primary mined ounce, we stand to attract a real and marketable green premium. With that, I'll leave it there and hand over to Charles. Thanks.
Thank you, Grant, and good morning to all participants. We continue our disciplined capital allocation. Work on the Burnstone project and the K4 project is progressing well, with K4 hoisting its first ore during H1 2022. The estimated capital expenditure on these two projects for 2022 is in line with plan at 2.1 billion rand. Our cash reserves at 27 billion rand exceeded our target of 20 billion rand and supports our flexibility and optionality. If we turn to stakeholder shared value, we have declared an interim dividend of 138 cents per share or 3.9 billion rand, which remains at the top end of our dividend policy. In terms of the 1.5% of equivalent dividend value for social upliftment projects, we are in the process of setting up the mechanism and the governance structures to manage these funds. We maintained our net cash to EBITDA at 0.16 times, and we remain in a robust financial position. 3 projects have been funded from the Bionic Cube. They are the investments in Verkor of 25 million euros, Anywhere of 5 million euros, and Glint of $6 million. The ongoing disciplined capital allocation has resulted in a strengthened balance sheet, which was achieved through a combination of debt reduction and cash generation. This slide illustrates the evolution of our debt compared to EBITDA, which peaked at a high of 2.6 times in H1 2018 and flipped over to a net cash position from H2 2020, a position we have maintained for 2 years despite significant returns to shareholders. The graph on the right highlights the dividends paid to shareholders since the resumption of dividends in H2 2019, and if we include the H1 2022 interim dividend that the board has approved, this number is over 29 billion rand, or approximately 3 times our market capitalization at listing in 2013. Despite the operational challenges highlighted, we still managed to produce a solid set of results. If we start with revenue is down 22% to 70 billion rand compared to the same period in 2021. The main impact was the 3-month industrial action at our SA gold operations, but also lower commodity prices across all our operations. Good cost control and cost containment during the industrial action has resulted in cost of sales being down 2% period on period. Amortization and depreciation was down 500 million, and this was in line with the lower production at both our SA Gold and SA PGM operations. Profit before royalties and tax was just under 19 billion rand. Royalties and taxes for the period were 6.6 billion rand compared to the 10.7 billion rand in H1 2021. Royalties and taxes were both lower due to lower overall profitability for the period. Profit for the period was 12.3 billion rand, the third highest profit for a half year since inception, and normalized earnings was 11.2 billion rand. This translated into earnings per share of 426 cents per share. Thank you, ladies and gentlemen. I will now hand you back to Neil to take us through the conclusion. Thank you, Neil.
Right. Thank you, Charles. And I really only have one slide left to conclude. So let's have a look at that. The challenging H1 period is behind us. I've explained why it was challenging, and what we expect in the second half of the year is that both the South African gold and the US PGM production will normalize, certainly by the fourth quarter. The South African PGM business will continue moving down the cost curve and generating strong cash flow, and certainly getting back to the right volumes will help that. So the operational outlook for the second half of 2022 is significantly better, and we will position for that. In terms of other positioning, our regionalized management structures are in place. They were a refinement of our previous structure and necessary to ensure that we have capacity for growth. And of course, they will focus on the strategic essentials during this period. Our strong balance sheet provides resilience against an anticipated macroeconomic downturn. We have maintained discipline when it comes to capital allocation, as you've seen with the dividend declaration. But what we haven't spoken about a lot today is we've been very deliberate and very patient regarding our approach to M&A. And you've probably heard me say a few times in the public domain that we don't see value yet in areas that we're interested in. And we will sit on our hands until we can find value opportunities. We're well prepared for this very complex global backdrop and future scenarios. The global geopolitical and macro environment is very volatile and uncertain, but I think you should have confidence in our assessment of these issues based on the 8 grey elephants that we discussed at the beginning of the presentation. Our PGM business is very well placed for an extended internal combustion engine cycle. We've never been proponents of the demise of the internal combustion engine in the short term, and of course, even if we're wrong in terms of the internal combustion engine, you've got very significant demand underpin being built up from the hydrogen economy. So we remain confident in the long-term demand for PGMs. In terms of the supply of critical metals into those chosen regional supply chains, which includes PGMs, by the way, but our battery metals positioning into really high quality projects, into high quality countries, is actually turning out to position us well. And I can see very significant revenue generation in the not too distant future from these investments. On a macro scale, again, our diversification, both from a commodity and a geographical point of view, has addressed risk and ensures a balance in our portfolio. So with that, I would hand over to James, and we would be very happy to take your questions. Thank you, James.